compressed in 1 year will be joy, depression, and rally, right? I think just
Tom Lee just called for a 15 to 20% correction in 2026, and he's still bullish. If that sounds contradictory, stick around. You're missing something important. Look, if you're short on time or you refuse to listen to some random cat on the internet, Tom Lee believes earnings growth will carry the market higher this year, even if valuations compress. The catch? He expects a gut-wrenching drawdown somewhere in the middle before the rally resumes, and my own model kinda agrees with him. So if you're not prepared for both scenarios, you're gonna have a bad time. Hey, I'm DataCat. A quick intro for those who are new here. Former corporate analyst. Spent years inside a Fortune 50 company staring at spreadsheets until my eyes bled. Now I traded the fluorescent lights for lasers and keyboards. Literally. My cat keeps attacking the laser pointer while I'm trying to record these videos. So my channel's been around for about 5, almost 6 months now. I'm not some finance guru with a course to sell you. I'm just an introvert who got tired of watching people oversimplify markets, and honestly, I figured I could do a slightly less terrible job explaining things. The bar was low, like cat sleeping on the floor low. If this is your first time here, I break down institutional research and translate it into something actually useful. No hype, no 10x your portfolio nonsense, just, actual analysis. Or we could also hope I do genuinely find the next multi-bagger stock, so that we could all retire early. Alright, enough with that. Let's get into what Tom Lee is really saying about 2026, because the headlines aren't telling you the full story. So Tom Lee, Fundstrat's head of research, has a pretty specific framework for this year, and I want you to understand the logic behind it, not just the price target. His central argument is this: earnings will do the heavy lifting, and the PE multiple can actually come down. Now wait, if multiples compress, doesn't the market fall? Not necessarily, and this is where most retail investors get confused. See, if earnings grow fast enough, stock prices can still rise even while valuations get cheaper. It's like, imagine your cat gains weight but somehow gets faster. Doesn't make intuitive sense, but it happens, don't ask me how. Cats defy physics. What Lee is really saying is that the market's next leg up won't come from people paying even more for the same mega-cap tech names. Instead, he expects broader participation, financials, energy, small caps to contribute to earnings growth. The Magnificent Seven, in his view, will track earnings rather than getting additional valuation expansion. This is actually a subtle but important distinction. He's implicitly cautious on the everyone pays any price for the same few stocks dynamic. That's the bubble risk everyone worries about. His view sidesteps that by betting on rotation. But, and this is critical, he's not calling for smooth upside. He literally describes 2026 as a year of joy, depression, and rally, compressed into 12 months. So if you're expecting a straight line up, you're setting yourself up for an emotional wipeout. This brings me to the second piece of his framework. The path of returns matters as much as the destination. Lee expects the market to start strong as sentiment improves. Then, and I'm quoting loosely here, the market will test the new Fed. That means uncertainty about how the Federal Reserve reacts to things like easier financial conditions, potential inflation reacceleration, or labor market tightness. In plain English, markets are going to probe whether the Fed will tolerate risk assets running hot. And if investors conclude the Fed will be less supportive than hoped, you get a drawdown, possibly a nasty one. He's penciling in a 15 to 20% correction at some point, probably mid-year or later, and then a recovery into year-end. Now here's what I find interesting from a positioning standpoint. Even if his year-end target is higher, there's a period in the middle where risk assets feel, his word, broken again. That's the moment most people panic sell. That's the moment you have to decide whether you actually believe in the thesis or you were just along for the ride. My cat, by the way, never panic sells, mostly because he doesn't understand money, but also because he's emotionally detached in ways I aspire to be. Okay, so what's supposed to drive this eventual recovery? Lee highlights a few macro catalysts. First, Fed rate cuts. He leans on monetary easing as a tailwind, especially for rate-sensitive parts of the market. Small caps, cyclicals. Lower rates mean lower discount rates for growth stocks, better refinancing conditions for leveraged companies, and improved risk appetite broadly. Second, the ISM Manufacturing Index potentially moving back above 50. For those unfamiliar, 50 is the dividing line between expansion and contraction. A sustained move above 50 typically aligns with better cyclical earnings, improved market breadth, and stronger small cap performance. He frames this as a green light for growth. Now, 1-month prints can be noisy. What matters is a sustained trend. But if ISM confirms expansion while the Fed is cutting for the right reasons, normalization, not panic, that's a constructive setup. Third, and this is more implied, he expects small caps to benefit. He points out small caps made an all-time high in 2025 and sees them supported by lower rates, improving earnings, and M&A activity. His broadening thesis is basically pro-cyclical, pro-domestic. Let's talk specific sectors because this is where the rubber meets the road. Energy is his top pick. And yes, I know, oil has been surprisingly weak. There's even a technician view floating around that crude could hit $40 early in the year. But Lee's argument isn't oil must rally. It's a valuation and positioning argument. Energy stocks have lagged for a long time. Expectations are low. Large integrated majors can still perform via cash flow discipline, buybacks, and valuation re-rating, even without a big move in spot prices. He's betting energy equities start pricing in a better forward oil environment before spot catches up. That's a contrarian setup. It could work. It could also fail spectacularly if oil at 40 signals demand weakness rather than benign supply dynamics. Financials are also on his list. The logic. If the Fed cuts because inflation is cooling without growth collapsing, financials benefit from better capital markets activity and credit conditions. If the Fed cuts because growth is breaking, financials suffer via credit losses. So this one's thesis dependent, soft landing required. Now, I wouldn't be doing my job if I didn't flag the risks, and there are a few that stand out. First, consensus is bullish, like publicly, loudly bullish. Major publications running headlines about experts expect rally to keep going. That's a classic contrarian warning sign. When bullishness is consensus, markets become vulnerable to any disappointment. Lee himself expects that correction, so he's aware of this dynamic. Second, timing risk. Calling for a high year-end target and a large correction means timing matters a lot. The practical risk is the correction comes earlier or deeper than expected, the rebound fails to fully retrace, or earnings don't deliver while multiples compress. That last scenario, multiple compression without earnings growth, is the bad combo you want to avoid. Third, and this is something I track separately, there's a quantitative risk indicator I monitor. It's designed to flag late cycle crowding and nonlinear instability after periods of rapid upside. It's been consistent with elevated drawdown risk into mid-2026. Now, this isn't a crystal ball. It doesn't predict exact dates or sizes, but it tends to appear when markets enter a regime where they're more sensitive to catalysts. Policy surprises, rate volatility, positioning unwinds. In that sense, it's broadly consistent with Lee's mid to late year correction framework. So how do you evaluate whether this thesis is playing out? Here's what I'd watch. 1. Earnings breadth. Are more sectors contributing, or is it still just a handful of names? 2. ISM and new orders. A sustained move above 50 matters more than a single print. 3. Financial conditions. Credit spreads, bank lending standards, refinancing stress in lower quality borrowers. 4. Fed communication. Is cutting framed as normalization or damage control? Huge difference. 5. Energy equity behavior versus crude. Like I said in my previous video, if energy stocks hold up even while oil is weak, that supports the re-rating thesis. If they trade like pure beta to crude, it weakens the case. Look, I'm not here to tell you what to do with your money. I'm not your financial advisor. I'm just a cat, a guy named DataCat, trying to make sense of complex research and share what I find. If this was useful, consider leaving a like. It helps the algorithm understand that not everything on YouTube needs to be clickbait. And if you want more breakdowns like this, subscribe. I'll keep translating Wall Street research into something that doesn't require a finance degree to understand. Alright, that's it for today. Stay sharp out there, and remember, even if the market throws a hairball mid-year, that doesn't mean the whole thesis is dead. Thanks for watching, DataCat out, and I'll see you in the next one.